Again, now we're going to talk investing, one of my favorite topics. Since I started doing these short videos, I've noticed the interest start to spike on a lot of people who are watching the videos. It seems that the message is starting to get through of the power of investing, the diversity elements that come from it, the feeling of accomplishment that comes from it, because you're taking all that reliability or that trust or all of that. Basically where you're at the mercy of one sort of business or one sort of client or something along that lines, where now you're starting to create options for yourself and you're starting diversifying and you're taking the pressure off yourself because you have alternative options. I want to talk about in investing the power of compounding. Compounding is a beautiful word. I mean, from somebody who's in investing, it's like a magic word, like, being in a relationship where love is something that everybody gets a smile off and goosebumps because it feels so great. For people in investing, that's what compounding is, man. I mean, it is such a powerful word in regards to what it can do for you in your life. But it's the power of compounding and understanding how it works that gives you so much freedom later in life. And so I want to do a simple example where maybe people can understand. And I'm going to take the stock market, because everybody knows the stock market, and a lot of people are not really educated or have enough knowledge of understanding how it might work or what to exactly invest in, or they understand the risks, and it's scary and people talk about it, and it is. I mean, you should really educate yourself first, but I'm going to use it as an example just to show you the power of it. You could go into the market today and you could buy a stock that basically pays a dividend. That's essentially a payment that they will give you for holding their stock, and how many shares, and each share that you own will be paid a dividend. And so let's take what everybody understands, and that's a bank. Oftentimes banks make a lot of money all over the world. And here in Canada, where I live, Canadian banks are the most powerful banks in the world. They've gone up against every bank from U.S. to all the way to the U.K. to Europe. They're the most powerful and strongest banks in the world, partly because of their regulations from the government and just how they're organized and how they're run. The point is that everybody knows what a bank is, and the banks have shareholders. Those are the people that own the shares that own the banks. They're publicly owned. And when you own a share, or when there's shareholders, corporations need to decide what to do with the money that they make, whether they put it back into their business to grow the business, or whether they give it back to the shareholders because they want to reward them for having faith and believing in their corporation and investing in them originally when the shares were disclosed. Now, when you get these shares, oftentimes the banks will decide, okay, we're going to have a strategy of paying a dividend. And we're going to start off with X amount of cents per share. And when they have a strategy that way, they spend their corporate careers, those organizations, to get maximum output or maximum value, create value for those shareholders, so that their stock will continue to go up because they'll become higher and higher demand. And so they'll set up strategies and say, well, look, for every dollar we make, this is our goal that we are going to pay back to the shareholders for owning and believing in our corporation. And they'll set that out in their corporate strategy when they form their company, or later on when they change their strategy if they go to a dividend policy. And so they'll decide, okay, we're going to pay out 50%. Of every dollar we make, we're going to give 50% back to the owners of this corporation. And so they're going to pay out. So if they make $1 billion, they're paying out $500 million to the owners, which are going to be distributed along those shares. Okay, so if there's 500 million shares, everybody's going to get $1 per share. Okay, and so now the great thing is that these corporations, this creates value for the owners because there's security in it, that they're going to get paid, and if the corporation is motivated to keep making more money, they're going to make more. And that's why the Canadian banks have always done so well, is because they've always taken care of their shareholders. They've always tried to increase the value of their companies and the successes they have and give back to the shareholders. So these bank stocks continue to create value and continue to be high demand, and then they're constantly traded and being bought, and that drives up the price when there's high demand. Well, as the price goes up, that percentage that they're giving goes down, because when they give a dividend, there's a yield on it. Essentially, you're getting a rate of return, okay? So if they're saying to you, we're going to give you 5% of your investment. You buy this stock today at this price, we're going to give you 5% return either monthly, quarterly, annually, and most banks pay quarterly. They'll give you a dividend based on that rate of return. It's usually a fixed dividend. And so as the stock price goes up, because it comes higher and higher demand, that yield goes down. So you're not getting as great a return because you're paying more to get the same dividend than someone might have paid $10 cheaper a month ago. But the great thing is, remember what we said, they're motivated to keep the shareholders happy at a certain corporate strategy. So then what they do is they turn around every 3 months and they reevaluate the corporation. They say, well, look, our price has gone up. The yield, the rate of return's gone down. We got to make these guys happy. Let's raise the dividend. So they'll raise it back to that yield that they're comfortable with, which is usually between 4 and 6% with banks. And then what happens to all those people that own those shares? All of a sudden, their yield actually went up because the dividend was increased and they already had their shares. Now, where the compounding starts to kick in is essentially that if you invest your stock or your dividend every time you receive it back into that company, well, then what happens? Then the dollar cost averaging of reinvesting that money back in starts to compound because you're reinvesting maybe at a lower dollar amount where the yield was high or maybe the yield was low. But then when they start raising that dividend, all of a sudden all those shares you used to own or collecting, they start to become worth more valuable. What does this do? This continuously causes the stock price to drive up. And if you look historically at bank stocks, they continue to go up almost year after year after year, and then what happens is when they reach a certain stock price, they say this is becoming too expensive, once again creating value for the shareholders, saying we don't want to be this high, because if we're this high, we can't sell to the people, everyday people that might be able to afford it. So if their stock price goes up to like $100 a stock, then all of a sudden they say we're splitting. We're going to take that stock price and we're going to split the shares to $50 or maybe a one for four, or 4 for 1. So then they'll go down to $25. Now it becomes more affordable for everybody again. And all those people that own those shares before, now if it was a 4 for 1, they've quadrupled their shares. The dividend hasn't changed. Now all of a sudden, they're going to be making the same payment going back and buying the stock now at $25 when they reinvest that income that they're receiving every quarter. I mean, this is crazy. It's absolute craziness. And for an investor, it's a dream come true, because over 10 to 20 years, you can turn an investment that might have been $10,000 or $20,000 to $500,000 to maybe $1 million, depending on the stocks. If you look at the Microsoft stock as a prime example of stock splits. Now, it didn't pay a dividend early on in its career. Now it is a dividend company. It's changed. With Bill Gates not being part of the company for the last 5 to 10 years when he's retired, he's a shareholder now. And so where do you want to do? Obviously, the policy is going to change because he's not going to get direct profit from the company. He's going to get it in his share value. So it changed to a dividend policy. And now the compounding and possible stock splits, you could see if you look back at the history, just Google it, just check it. You will see someone who maybe invested $1,000 or $10,000 became a millionaire in over 10 to 20 years, easy, multi-millionaire with stock splits and dividend compounding. Now, without getting too technical and getting into it, I think what you need to do is just to sit down, pick a good blue chip company, look at its history, one that pays dividends, that's gone through stock splits, and just look. If you had invested something 20 years ago at $10,000 or $5,000 or $1,000, where would it be today? It's absolutely nuts what compounding can do. I cannot vouch for it. It is the best type of way of investing, the most highest ROI that you're ever going to get in your life. It's fantastic, but I want to motivate you. Just spend some time, do some research, and you will see what I'm talking about. Talk to you guys next time.